Hello, chart watchers, and welcome to this Wednesday, September 26th, Market Watchers Live Show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. We got the Dow Jones Industrial Average currently up 50 points, the S&P 500 up 7, the NASDAQ is up 29, doing well on a relative basis. Small caps, though, lagging again, trading back down near that 1700 level, down about 6 points today. 10-year Treasury yield just hovering here below the 3.10% level. Of course, it is Fed day, so everyone anxiously awaiting not just what the Fed's going to do, because I think that's pretty clear, but what the Fed is going to say, and that will be out at 2 p.m. this afternoon, Eastern Standard Time. Volatility index continuing to move lower, remains in a downtrend. It is now threatening to break back down below 12. Healthcare continues to be extremely strong. You can see that the consistency in this advance is quite evident from the last 2 months' action. It is leading again today to the upside. Consumer stocks following suit, though. We've got consumer discretionary returning to the forefront, along with consumer staples. Biotechs strong within that healthcare space. IBM getting an upgrade. Erin will be talking about that later. Nice breakout on IBM. And then getting back to those consumer discretionary stocks, getting some help from the retailers. Apparel retail been moving sideways really for about the last 5 weeks or so, having a strong day today. Be watching to see if we get a breakout there. Erin, it is hump day, Wednesday. Weeks just seem to be flying by. Now we're about ready to end another month.
I know. It's, wow. It's summer flew by, and now already it's fall, and we've got so much going on in the markets as well. I mean, I've just been watching all of this, and, yesterday I wrote an article that all of these sectors right now, except for XLC, which is brand new, so I didn't count that. But on our sector scoreboard table, every single sector right now is on an intermediate term and long-term trend model buy signal. So it's pretty hard to get bearish when you have all sectors in both of those longer-term time frames on buy signals.
Yep, and we are heading into the most bullish quarter of the year, the fourth quarter, when the market does tend to do well heading into year end and to start a new year. But autumn is here, as you said, and so is Tom McClellan, another special guest. Great to have you back on the show, Tom. How are you doing?
I'm glad to be with you guys.
I know you've got special stuff for us, because you always do. You always bring these things in, and I have no idea. I think that there was a couple of ratios that you were looking at or have looked at in the past, which, suggested that maybe we would have a big rally heading into the latter part of 2018 and maybe for the next couple years from what I recall. So I don't know if you're planning to talk about that at all, but I'm sure our listeners would love to hear at least a comment or two about that.
I'm ready to go if you guys are.
Well, we're going to have you in here to take off in about 15 minutes if you can stick around with us.
I'll do that.
Absolutely.
Excellent.
Always great to have Tom in, and he's got some interesting information to share, as he always does. So, Erin, we got a lot going, so why don't you just take it away?
Yes, and I took a look at this upcoming schedule beforehand, and it is packed full. We have Dan Russo coming in tomorrow from Chaikin Analytics. Mary Ellen McGonigal will be in Friday for What's Hot and What's Not. And the seasonality report for the month. I know you're going to be doing that on October 1st. And then on October 2nd, I'm going to do the DP monthly review. I'll go over all those monthly charts that went final and let you know about any signal changes that arrived at the end of the month. And then finally, we have Charles Kirkpatrick coming in on next Wednesday. So it'll be great to have Charlie back on the show. Today's agenda. As we introduced, Tom McClellan is here, and as we were talking about, autumn is here. 10 and 10 to 1, our first symbol will be Williams and Sonoma Incorporated, and we will finish off the show with What Would You Do? And it's regarding Nike. I encourage you, if you're watching live, to go into the chat room and take the poll on what you would do, and then we're going to discuss that and let you know what we would do. All right, Tom, time for some technical news and headlines. I know we did have a few economic reports released today.
Yeah, economic reports out today. We had August new home sales come in, 629,000 units versus 630,000 expected. The big thing here, though, was July was revised lower from 627,000 to 608,000. So that was a little bit of a negative for the group. That came out at 10 a.m. this morning. And of course, this afternoon, everyone is waiting for the September FOMC announcement. I think it's pretty clear that we're going to get another quarter-point rise. I think the Fed tries to be really transparent as to what it's going to do, and it's been pointing towards a quarter-point hike for some time now. So I don't think that's going to catch anyone by surprise, but I do think that everyone will be listening to every word from the Fed in terms of looking forward. You know, are we looking at another rate hike later this year? How many next year? Is the Fed concerned about inflation, or maybe the economy overheating? A lot of different things that I think all traders will be looking for to see what they can glean from the Fed's announcement later this afternoon. So definitely you're going to want to keep an eye on what happens at 2 p.m. I would say this, though, that the action that takes place right after 2 p.m., it's kind of like an earnings report. You know, the market kind of is trying to digest new information. And so you can get whipsaws in both directions. You think you have a trend going one way, and then it quickly reverses. I like to see how things settle down. So I do think that the key in that 2 o'clock to 3 o'clock hour East Coast time, of course, is going to be what happens with the 10-year Treasury yield. Do we get that breakout to a 7-year high above 3.11% after the Fed has spoken, or does it settle back down? Because if we top, and I think this is where it's pretty critical. I'm going to show you the chart here. But if you look at this chart, you can see this 3.11% area is pretty big. And if I stretch this out, we'll go back several years. I think it's really important because when you don't get through key resistance levels, you can see a huge move up into 2017. We pulled back, consolidated, went back up and tested it. I thought we were going to go through back then, and we didn't. And you can see what happened over the next several months. The 10-year Treasury yield came back down. That can really influence some of the areas of the market, like financials, the banks, life insurance, things like that, that are incredibly interest rate sensitive. So those are some of the things we want to watch for. We've got this double top. I think rates are going to go higher eventually, but I don't know if they're going to go higher today. So let's see whether or not we get this breakout when the Fed announces and has its talk after 2 p.m. today. But just watch and know that from a technical perspective, there's yield resistance sitting at 3.11%. And if we close above that today, in my opinion, it could signal much more selling of treasuries, which means yields going higher. And the selling of treasuries can generate money rotating into equities. And that can be very significant. There's a lot of technical evidence of the positive correlation between the direction of the 10-year Treasury yield. As you can see, we had that huge rally back in 2016, and it coincided with the Treasury yield moving higher. When the Treasury yield's going higher, again, you've got money coming out of the Treasury market, and that can be used to rotate into equities and fuel a very significant rise. So that's one of the reasons why we want to keep a close eye on 3.11%. I know there's some of you out there saying, well, higher rates is not good. That's going to slow down the economy. I think rates remain very close to historic lows. I don't think that a rate going to 3.5%, 4% on the 10-year Treasury is going to have a huge impact on our economy going forward. If it does, then the strength in the economy really isn't that great. So that's not what the market's telling me. We can go in and take a look, and I'm going to look at some of these sectors in just a minute. But what the market is telling me is that we're going to go higher. It's just a matter of when, not if. I'm not seeing any topping signs, or very, very few topping signs in the market. Let's take a look at the healthcare group, because this is a group that has been outperforming the S&P 500 quite a bit since early May. We bottomed on a relative basis back in May, and healthcare has been moving higher. One of the reasons, certainly today, that we're getting some strength is in the biotech space. So biotech's got a nice little cup off of an uptrend. Yeah, maybe we pull back a little bit from 2175, but I think this chart looks really nice. And from that May low, you can see that the biotechs have certainly been doing their part in helping the XLV. Also, we could take a look at a couple of other groups in this space. Medical equipment, been very strong, really since bottoming back in April. You can see this huge move to the upside on a percentage basis, even more than biotechs. Also, the pharmas, which had underperformed for so long, they've also bottomed. And as of that second week of May, there's been a huge run-up, 20% or so in this group. So there's a lot of areas of healthcare that are contributing to that strength. And I'm going to go back now and take a look at the relative strength of the consumer discretionary group versus the S&P, because here we've actually kind of struggled a little bit. This isn't bad action. We had huge outperformance November to June, and now we're just consolidating that, which I'm fine with. So the XLY relative to the S&P 500 going sideways, I don't really have an issue with this. I think this is actually very bullish, and eventually, maybe even in the fourth quarter, I'm expecting we're going to get a breakout here. When you look at the XLP, this is another group that's doing well today. It's consumer staples, the other part of consumer stocks. But you can see the more defensive staples area on a relative basis is underperforming. So the absolute chart on the XLP is still fine, but on a relative basis, they're not seeing as much money as we're seeing in other, much money rotate to it as we're seeing in other areas, which I think is very bullish. Here is the XLP. It's trending higher. Even the XLU, which has been struggling with the higher 10-year Treasury yield, the XLU is still, it was in an uptrend. Probably will find support somewhere down here around 50.5, 51 would be my guess. But the long-term charts, and I think this is a point that Erin was alluding to earlier, it seems like all the sectors are still pretty strong. Yes, money rotates, and we see some pullbacks from time to time in different areas, but overall the long-term charts remain pretty strong. And if we pull up a weekly chart on the XLU, you can see, actually, I see an uptrend, perhaps a cup with a pullback little handle here. So even the longer-term charts to me in all the key areas of the market still look pretty strong. Mentioned the home construction. I think I talked about them yesterday for sure. And we had KB Homes report this morning. I'm going to show you that chart in just a minute. But here is the home construction group breaking down. We had an okay report earlier on the new home sales for August. But again, July was revised lower. We got a nice gap up with earnings on KB Homes, but then that reversed. And you can see the home construction index setting a new low. And just as a reminder, an area that I'm kind of watching from a weekly perspective is this 720, 725 area. And we're currently at 719. Now, keep in mind, this is a weekly chart. So each one of these candles are weekly candles. It's only Wednesday. So let's see how we finish this week out. But it's possible that we could get a nice reversal here off of the 720, 725 area. If it doesn't, I mean, I wouldn't force trades in this area, that's for sure. We do see a group that continues to trend lower, but this is an area for bottom fishers that maybe I'd take a look at. Okay, let's take a look at a couple of other areas, and then we'll get into some upgrades and downgrades. I mentioned the apparel retailers at the top of the show. Here is the sideways consolidation we've seen now for about 6 weeks, but a really strong day today. Wouldn't take much to get a breakout in this group, and this has been a leading area within consumer discretionary, so it is worth watching. Moving on, specialty retailers. Also nearing a key breakout level near 1,700. We want to watch this. And then the clothing and accessories. Sideways consolidation, need a breakout over 375. So I know we got some upgrades and downgrades, Erin. What are you looking at there?
All right. Let us go and take a peek. We have 6, 3 upgrades, 3 downgrades that I'm going to go over with you. I'll start off with the downgrades. We'll start with the bad news first, I guess. Okay, here we go. Sienna Corporation, UBS downgraded from a buy to a neutral. I thought this was an interesting chart in that we did have a declining wedge here. A falling wedge, and those are bullish patterns. We got that breakout, but we were never able to really fulfill the upside potential from that breakout. And now we're falling back down, breaking back down below that declining tops trend line that did make the top of that particular falling wedge. So I thought that was interesting. And then, of course, I've got this PMO sell signal that was already in place when this downgrade occurred. So I'm not a fan of the chart. I don't see it as a bottom feeding opportunity at this point. I think that there's more room to fall lower toward filling this gap that we had, that breakaway gap in late August. So not a good candidate in my opinion. I didn't think any of the downgrades looked all that attractive as bottom fishing opportunities. Here is DuPont. Nomura downgraded them from a buy to a neutral. You could see we had a fairly longer term rising bottoms trend line, and today we are popping down below it. We might just go ahead and close and break and have that breakdown occur today by the end of the day. PMO is on a sell signal. You can see scooters in decline. OBV is making new lows. I don't think this is very attractive. I would be looking for a move down to this last area where we had support on this consolidation area, as well as that low from back in February. I would look for a move down to the $65 range. All right, Paycom Software also downgraded today. This was downgraded by B of A from a buy to a neutral. I decided I would go ahead and annotate not only the support and resistance levels right now, but also this rising bottoms trend line, because I think that's going to turn out to be more important than even the 20-day EMA right now. I would want to see this hold. At a minimum, I would want to see 145 hold. But, you know, looking at my PMO, it's got the sell signal in very overbought territory. It needs to unwind. Price needs to move out of that overbought arena. So I would be looking for a drop on the downgrade to at least 145. We could see it come down to these tops we had in that consolidation in early August as well. Those are two downside targets I'd be watching for, especially if we get the breakdown from that rising bottoms trend line. All right, 3 upgrades for you. Let's start with Canada Goose. And this one was D.A. Davidson is initiating coverage on it. And apparently the market likes this quite a bit. We are looking at an over 9% move to the upside. Obviously, it wouldn't want to be involved in chasing this one after a huge move like this. But as we've seen on some of the other stocks, you might get those big breakouts and it's just going to continue to run away on you. But this one, I would be looking for a little bit of a pullback, at least maybe to that top we had back here in August. And then that might be a good candidate to get in on. We do have overhead resistance at 65 and 67. It looks like more like $68. So keep those those levels in mind. GoPro. Oppenheimer upgraded from a perform to an outperform, another one that the market makers are enjoying and liking. Notice that the PMO was very flat. Of course, we've been in this long time area of consolidation here, and now we are finally breaking out. I wanted to make note that we are finally closing this gap that was formed back in January of this year. So we're finally seeing that gap close on an intraday basis. I think it would be especially good to see it close above that gap, but we already do technically have it filled as far as intraday goes on the OHLC bar. Notice that the scooter is now in that hot zone. I think this one looks pretty enticing. If we can get and hold that breakout up above that 750 area to close that gap, and rather than see it be used as resistance to bring price all the way back down again. All right. IBM, as Tom was talking about earlier in the show, did also come in with an upgrade by UBS from a neutral to a buy. And again, looks like the market's pretty happy with this, with a move up of almost 2.75% today for IBM. I was looking at this as a possible ascending triangle formation that did execute. And when you see these formations execute, you want to take a measurement of the back end of the pattern and then add that to the breakout point. I didn't do that as far as coming up with a target, mainly because this pattern took a really long time to unfold and break out. And usually when I start seeing price come to the apex of a triangle, you know you're going to get a breakout one way or the other, because it just has to drift on through either that rising bottoms trend line, or it'll drift up through the overhead resistance at the top of that triangle. And, you know, it took a while before we got a significant breakout to the upside, but we did get it. I would be looking for price to move all the way up here to that 157.50 level, where we should have some investor memory as to what those highs were back then. I would look for those highs to be reached at this point. All right. That is all we have for upgrades and downgrades. It's time to bring back in Tom McClellan. So good to have you here with us today.
I'm glad to be here with you. Hopefully you have some fun charts that people will like. I got a ton of them, so we'll try to get through all of them.
All right. Well, I'll be taking questions in the chat room, so feel free to put those in. And we did have one come in like right away that they loved your article on gold and the yuan, and they wouldn't mind you elaborating more if you have time.
Going to talk about that. We ready to go?
Yes, let's do it.
Okay, stand by. Let me make sure I'm pressing the right buttons.
There we are.
Come on, there we go. Yes, autumn is here, and we've been waiting for a long time for it. I'm going to review my top secret indicator here. This is euro-dollar commitment of traders data. It's from the COT report published by the CFTC, and it's looking at the net position of the commercial traders, they're the big money banks, in euro-dollar futures. And what we find is that the movements of this data tend to get echoed a year later in the stock market. So what I've done is I've pushed this red line forward by a year to reveal how when you see a big decline in that data, you get a big decline in the stock market a year later. So we've been focused on a big peak early in 2018, a big summer decline, and then the big rebound in the fall. That's the agenda. Hasn't worked out exactly like that. Let me zoom in a little bit. This is the same relationship. The red line is pushed forward by a year, and we got our March top pretty much on schedule. But wait, where was the bear market in the summertime? What happened to the S&P 500? It just kept on trending higher. Well, it turns out we did get our summertime bear market, just not in the U.S. stock market. Here, for example, is the Brazil Bovespa index, and it declined on schedule, seems to be rebounding on schedule. Here is the emerging markets ETF, EEM, topped right on schedule in March with a little wildness in January to precede it, fell right on schedule. So the rest of the world saw the summer decline like it was supposed to, and it seems to be turning up for the autumn just like it's supposed to. Here's another one. This is the MSCI World Index minus the U.S. They take the U.S. out of it and just put the entire rest of the world into it. And sure enough, it had the weakness in the summer like it was supposed to, and it appears to be bottoming and turning up on schedule. So why was it that the U.S. market failed to respond to the illiquidity event that this leading indicator told us about? Well, here's one answer, courtesy of a study just released by the Federal Reserve. They looked at S&P 500 companies, and all 500 of them, which must have been a Herculean task to do computations, and looked at what the rate of repatriation back into the U.S. from their offshore profits is. And you can see that for most of the time, it's relatively low and static. But then once we got the tax law change and going into effect in the first quarter, boom, look at all that, $313 billion coming back from overseas banks into the U.S. And that money had to go to work somewhere, so it's gone to work helping the U.S. stock market. To put that $313 billion first quarter figure into perspective, that's 3 months. That's a little over $100 billion per month. Per perspective, back in QE3, the Fed was pumping in $85 billion a month. So we basically had a QE4 courtesy of all that money coming back to the U.S. It tapered off a little bit in the second quarter because they got it all done in the first quarter, but it's still happening at more than twice the natural background rate. And so all that money coming into the U.S. and leaving foreign banks has a predictable effect on the relative performance of the U.S. versus the rest of the world. We're in the second year of a presidential term, almost about to enter the third year, and I count those years as starting November 1st because that's when the election takes place. And this is my presidential cycle pattern. It's calculated by taking the S&P 500 price history, chopping it up into 4-year blocks of time and averaging their performance together. So this is what the average performance looks like of the S&P 500 over the 4 years of a presidential term. And that most people know the first 2 years are generally sideways. You don't make much progress generally in the first 2 years. The third year is really strong up. And then the fourth year is also strong, also up, but not nearly as strongly because people start worrying about the election. Well, this is what the S&P 500 has actually done. We're setting both of them back to an initial starting value of 1 just so we can see what the relative performance is. we seem to have pulled forward a lot of the third year gains into the second year by bringing all that money home and pushing the U.S. stock market up. So then the question is, do we get this big third year upturn like the presidential cycle says and like the Eurodollar magic indicator says, or have we already had those gains? And that's a good question. We're turning into annual seasonality. This is the same idea. We're looking at the annual seasonal pattern instead of the 4-year seasonal pattern. You chop up the data into 1 year chunks of time and average them together, and that's what the average annual seasonality looks like. It didn't work too well at the beginning of 2018 because we had this big blow off in January, the short VIX squeeze that had a little crash in February. But then as we got to the middle of the year, it started correlating better, but with an interesting twist. There was a little bit of a lag. So the bottom was supposed to be here, but it actually occurred about a week later. And the bottom was supposed to be here. It actually came about a week later. We're seeing that as the pattern plays out. The stock market has been trending higher instead of lower like the pattern says. So that's a big difference, but the dance steps are still there. So here's where the seasonal pattern says the bottom is supposed to be, which is September 24th. If we continue with this 1 week lag that we've been doing, that means we get our bottom somewhere around here due October 1st. It's still the same bottom. It's just, it's doing the same dance steps a week late. And then the seasonal pattern turns up. We'll see if we can get to do that. There are some problems though, because we're not seeing strength matching the stock market strength in the high yield bond market. If you look at measures like HYG or HIO, high yield ETFs, some of those are still doing okay, but they are dominated by some of the larger cap issues. This is an advanced decline line for corporate high yield bonds. It's data that's kept by FINRA, and I access it every day, and I have to go fetch it one day at a time because they don't make it available in a time series, but it's such good data that it's worth doing it. We're seeing attempted to make a breakout to join the stocks, but that's kind of failing. It's got a divergent lower high compared to higher high in stock prices, much like what we saw back in January. That's a problem. It says that the most liquidity sensitive issues, the high yield bonds, they're not participating in the party. All the liquidity is going to lifting the large cap stocks. So that can be a problem. It could get resolved if this starts performing better. That could resolve the liquidity problem that this is warning about. But for now, it's a concern. We're seeing a similar advanced decline line divergence in the New York Stock Exchange advanced decline line. It looks at every stock on the NYSE, how many of them are going up versus how many of them are going down every day, and you calculate that on a cumulative basis. When you see divergences like this, that's a warning that liquidity is becoming a problem. The big guys are able to garner their share of the liquidity, but the little ones that populate most of the list are not doing as well, and that can be a big source of concern. And that's different from what we've seen throughout all of 2018, where the advanced decline line was acting strong and saying that things were good. It's saying there are problems now. And that weakness in the advanced decline numbers shows up in the McClellan oscillator, still negative. It refused to go up above zero as the New York composite was making higher highs. That's not a positive sign. It's forming a complex structure below zero, and the complex structures indicate which side has the strength. We got a conflicting message from having a complex structure above zero, which said that the bulls were strong, but now the complex structure below zero says the bears are in charge until further notice. We're also seeing a divergence in the number of NYSE issues making new 52-week highs. Prices are making higher highs. This is making lower highs. That's not generally good news because it says there's waning participation among the masses in the uptrend. Now, not all divergences like that have to matter. Back here in 2017, we had a couple of good-looking divergences just like that, but they got rehabilitated. They got off the Group W bench that Arlo Guthrie told us about and saw a higher high, and so then the problem was resolved. But when you have a big divergence like we saw in January, not making higher highs as prices do, that is a warning of a problem. Doesn't have to mean calamity, but it's telling you something's wrong. We're speaking of new highs, we're also seeing episodes of the Hindenburg omen. And that's an indicator created, or it's a signal created by the late Jim Mika as a modification of Gerald Appel's old signal called the split market sell signal. Gerald Appel years ago wrote about how it was a problem if you saw both new highs and new lows exceed 45 issues on the same day. Well, that was never adjusted for the increase in the number of issues. So Jim Mika took it and ran with it and quantified it a little bit differently, added some other filtering criteria to create the Hindenburg-Omen. Now, the criteria that I use are as Jim Mika published them. He's not around to answer for it, but he told this to Greg Morris in Greg Morris's book, The Complete Guide to Breadth Indicators. You'll see different criteria around if you go to different websites, because Wikipedia says different criteria, and you can't argue with Wikipedia because it's always true. But these are the criteria for this signal that Jim Mika came up with. Interestingly, when you get a single signal, it doesn't usually matter as much as if you get a cluster of them all together. And the more you have, the more interesting it is. We're so far at 10 and counting on this current cluster. We had 5 back in January and February, which was a pretty good indication of a top. But we also, in late 2017, we had a cluster of 7 of them, and that didn't turn into any calamity. The signal remains in effect as long as the McClellan oscillator is negative. That's the third criteria. As soon as the McClellan oscillator goes above 0, then the signal's canceled and you move on. But Jesse Felder of the Felder Report did some interesting analysis. He came up with this indicator that I've replicated. He counts the number of Hindenburg-Omen signals over the past 6 months. And when you get really high totals, it tends to be more significant. It didn't matter at the moment right then in this instance in 2006, but you got another spike in late 2007 or early 2008. We saw a big spike. That was the all-time record of 12 of them in 6 months occurred at the top in January, and now we're up to 10 and counting. So it's a little bit of a concern. There's other reason for concern. Some data that's put out by Investors Business Daily. They look at the premiums being paid on puts versus calls, and we smooth that with a 5-day moving average. That's up a really high. It means that people are much more interested in paying up for call options because they think that the market's going to continue going higher. And when you get high readings like this in the past, that tends to be associated with tops. And what high is can vary over time. Here's an example of high, but we're forging new territory in terms of what high means. And so sentiment is a bit of a problem, in addition to liquidity being a problem. And IBD's short interest indicator is also up at a very high level. It doesn't always have to matter, as we saw in 2017 when there was lots of liquidity pushing the market higher. But generally speaking, when you get one of these big peaks, it tends to matter. So this is one of the difficulties that the stock market's going to have in continuing to push higher into the autumn like it's supposed to. I'm not sure how that's going to get resolved. I think that for the next week or so, until about October 1st, we're vulnerable to a big drop. After that, a little bit less vulnerable, but I'm not going to be boldly courageous and bet that the autumn rally that I've been anticipating is going to take off until I start seeing some more confirming signs and elsewhere in the stock market. Switching gears, I want to talk about precious metals a little bit. Here's a chart of December futures for silver. And ever since blow off top in June, it's been making this stair-step pattern. It happened sharp drop, go sideways, sharp drop, go sideways. That has persisted, and it was continuing earlier this month, but now that's changed. Now we've broken out higher out of this go sideways range and broken a downtrend line. So whether this is another blow off or a fake out, we don't know, but it's certainly something different is happening than what used to be happening, and that's got my attention. Whether silver can go higher, it probably depends on whether gold can go higher, because the two are joined, and silver can wander a little bit on its own, but if gold doesn't join, then they're probably not going to go very far. And what we found recently is that the price of gold measured in dollars tends to be strongly tied to the exchange rate of the Chinese yuan. Here's a comparison of the two, and the correlation is pretty obvious, at least this year. And so only if the yuan exchange rate is going to get allowed to go higher can we expect that gold will also be allowed to go higher. If China keeps it going sideways, then gold is likely to continue going sideways as well. This is an interesting relationship because it hasn't always been the case. It's really just in the last couple of years that it started correlating so closely. And I like this chart because the place where this big drop in the yuan decided to stop was right at the level of an apex of a symmetrical triangle back in early 2017. Most people who look at triangles don't pay attention to the level of the apex, but I find it's very important. An apex can matter in terms of time because it can mark a top, or it can measure in terms of price as forming a new support resistance level where one had not existed before, and it sure enough came in and stopped right there. It was also an important level on an even longer term basis because way back in 2008 to 2010, the Chinese central bank held the yuan relatively fixed for a couple years. So they really, really liked that level, and it was allowed to wander for a while. Came back to it, wandered for a while, but came back to it. So somebody in China really thinks that this is an important level that the yuan should be at compared to the dollar, and they've managed to make it happen again. As the yuan has come back to revisit that same level, that's happening as gold is coming back to revisit the top side of its broken downtrend line dating back to the 2011 top, which makes it further interesting. Gold is further interesting this week because we had a full moon on Monday, and years ago I set about trying to prove that it was not true that the full moon schedule mattered for gold, as some people were asserting, and I failed in that proof, or that disproof. It really does tend to matter. You see, when you have a full moon, that tends to mark a turning point for gold. Sometimes it's a top, sometimes it's a bottom, sometimes it's an acceleration point. And so you don't know what sort of significance you're going to have until it's upon you. And that's going to be really frustrating because, okay, I can look at what the full moon schedule is for the next 200 years, but what sort of significance it's going to have, you don't know. At the same time in this chart, there is an independent and separate 26 trading day turning point pattern in gold prices. So about every 26 trading days, you get one of these turning points indicated by the red arrows. Sometimes it's a bottom, sometimes it's a top. You don't know what it's going to be. Interestingly, this time we have a confluence of both of those factors at the same time. So it's like two different cycles are teaming up to say that this should be a really important turning point. Hasn't happened yet so far this week. Gold is remaining stable and quiet, but give it another week and we'll see what happens. I think that gold should start heading higher. That's my bias in how to interpret this signal. All this says is turning point of some kind, but you don't know what kind. My bias that gold should go higher comes from looking at some more data from the Commitment of Traders report. We saw last week, for the first time, the commercial traders of gold futures have gone actually to a net long position for the first time since 2001. Most of the time, they are at varying degrees of net short, but for the first time, they are net long as a group. The bias toward the short side that they show happens for a natural reason. A lot of gold producers fit into the commercial trader category, and when a gold producer sells its future production, it becomes short. It's long the gold that's in the ground, but it's short the contract to deliver the gold next December. And so when you see this happen, that they're no longer net short, they're actually back to neutral, that's saying that they're looking at this price and they don't want to sell their future production at this price. They'd rather wait for a better opportunity. The guys who produce gold, who are smart about gold prices and know what's going on in the gold market, they're saying, no, this is not a good price to sell at. We'd rather not sell our gold and we'd rather wait for something better to happen. And that tends to be important. It tends to be a marker of an important low, like we saw in late 2015 or the lows of 2013. So this has got me very excited about the prospects for gold. Here's same sort of indication. First time ever in history of the Commitment of Traders data, we're seeing the silver futures net long as a group. First time ever. So that's got to mean something. They're saying that this is not a good price at which to sell. So they don't want to sell. And usually they're net short to varying degrees, but now they're net long for the first time in history, and that's got my attention. At the same time, the commercial traders of dollar index futures are net short in a big way, like they were back in 2017 or like they were back in 2015 and 16 when the dollar was making peaks. So I'm thinking that this means that we're seeing a big broadened peak in the dollar, and that they're going to be proven right in their short position in the dollar index futures. A declining dollar index should mean some support for gold prices and for other commodities prices. May not be good for other things, but it should be helpful to U.S. trade. And finally, in the commodities area, this is my leading indicator for crude oil prices. And it's found by taking the price plot of gold prices, shifting it forward by 20 months. So this low in crude oil was the echo of a low 20 months earlier in gold prices. We saw similar echoes. That's the same dance steps showing up again and again. Gold prices 20 months ago and beyond were in a choppy uptrend. So that's my expectation, is that we're going to see a similar choppy uptrend for oil prices into 2019, but then it should start going down again to echo gold's decline once we get into early 2020. So to close, I'll remind everybody, if you want to learn more about our indicators, you can come to our website, sign up for one of our newsletters. We also have a free weekly chart in focus. That article is just I pick a chart or an indicator and talk about it. You can sign up for free, no strings attached. We won't ever spam you. We won't sell our list to anybody. We just believe that that's the right thing to do. But it's a way to get more people acquainted with our indicators. And with that, Erin, I'll turn it back to you if there are any questions. You'd like to go back and see your chart and review it.
All right. Well, let's see. As far as the chat room, one of the topics is the dollar. And, you're talking about gold doing well. And, one of the things that they were mentioning, and I think it's a good question, is that, generally when you see the U.S. rates start to rise, the dollar tends to get stronger. And right now it's getting weaker. What do you make of that? And I know that if we do end up with a weak dollar, we should expect, gold to do better. What are your thoughts on that?
Yeah. Well, my first thought is I tend to trust the experts, and these guys are who my experts are, the commercial traders. They're saying that despite the factors that you just mentioned, they would rather be short the dollar in a huge way. So they must know something. The other part of it is that, yes, U.S. rates could rise, but other rates like Japan's or Germany's, those could rise even more and make their own debt more worth investing in than sending their money to invest in the U.S. Treasury debt. So that would be part of the answer. I don't have a good macro answer from knowing what the entirety of the world is going to do. I just look at who's the smart money and how are they betting, and that's where I take my guidance from.
Absolutely.
Hey, I got a follow-up question there, Tom. Because obviously when the dollar's doing something, you expect the opposite from gold. But I'd look at it even a little bit differently. I mean, I think since the dollar bottomed about 6-7 years ago, the problem with gold, in my view, is that it has continued to underperform the S&P 500. So even when we have seen some bounces, they've been very temporary in gold. And relative to the S&P 500, those bounces have been very minimal and have quickly been erased. So I guess a question, because the dollar, even during a period of a lot of weakness, I mean, we've seen it just recently, but throughout 2017, we really didn't see the huge bounce in gold, given the significant drop that we saw in the dollar. So I'm just curious, because everything you invest in, there's always you've got other choices to make. Do you want to invest in gold? Do you want to invest in something else? And I know the gold versus the S&P 500 ratio, literally since late March this year, has been going straight down. It's like a ski slope. So while the dollar has still been weak, the gold still doesn't seem to be gaining anything relative to the S&P 500. So one question, I guess, is whether or not to get into gold. But then another question is, even if you like gold, do you like the S&P 500 more? And based on the third year of the presidential cycle, the fourth year of the presidential cycle, have you decided in your own mind which of these you think is a better investment? Is it gold based on what you're seeing on some of the charts that you've just shown us? Or is it the S&P 500, which has been clearly outperforming most of the rest of the world, and now we're heading into that year 3 and 4? Just kind of your thoughts on what you think in terms of the relativity of those two investments.
That's a great question, but I will remind everybody what I started out with talking about gold. If you believe that gold is going to go higher, as the smart money says, then you have to believe that the yuan is going to go higher. And thus you have to believe that China is going to allow the yuan to go higher. And that's a tough belief system to try to get my mind around, because China tends to like to put its thumb on the scale in a big way. And so that could be the real flaw in any analysis about what gold should do. Gold has stopped going down for sure and gone sideways, but it hasn't really turned up like it's supposed to. So that's China may be keeping its thumb on the scale and interfering with any great calls that any of us might make about what gold should do. But your other part of your question was about the performance of stocks versus gold, and we've looked at that going back all the way to the beginning of the stock market in the 1700s. And what we find is that the Dow to gold ratio, or the S&P 500 to gold ratio, that tends to move with consumer confidence. And we're hearing record readings or multi-year record readings for consumer confidence indexes like the University of Michigan or the Conference Board. They're saying that the consumer is very, very confident in the economy and in their own personal economic situation. When that happens, they tend to invest more in the stock market. When consumer confidence is falling, then you'll see a underperformance of the stock market versus gold, or saying that another way, you'll see outperformance of gold versus the stock market in times when consumer confidence is falling. So if you really want to see a period where gold is going to outperform the stock market, then what you want to have in order to achieve that is you want to have falling consumer confidence. I don't see the signs that that's going to start happening anytime soon, but maybe if there's a change in the political situation in Washington, D.C., or some other phenomenon that happens, war breaks out or major trade war, something else like that, that starts to shake consumer confidence, then you can start to see gold outperforming the stock market. We're not seeing that turn happening just yet, though.
Excellent. Excellent answer. Do you have another question there, Erin?
Just one, and again, this one's really rather general, and Tom B, you may want to chime in on this one, but I think we've all been talking about how September was really better than expected seasonally. Generally it's kind of a depressed month, and it didn't turn out to be so bad, at least so far. So should we expect a bad October? Should that concern us? And I think you touched on it with the presidential cycle, but
well, I have some thoughts, but I'm going to let Tom McClellan go first if you have any thoughts on that, Tom.
Well, there's at least two ways to think about that. If you see a period where it's supposed to be weak and it's acting strong, then that's a sign of strength, and strength tends to beget more strength. The question, though, is have we taken the strength that was supposed to come in October, November, and pulled it forward and eaten our dessert first in the summertime? And that's a question I'll have a perfect answer for in a couple of months for you. So, but we can still use the seasonal pattern for interesting purposes by noting that the dance steps of the minor parts of the pattern are still showing up when they're supposed to, with about a 1 week lag. So I'm not very positive on the stock market for at least the next week or so till we get about to October 1st. I have an important bottom signal from other work that says that this September 24th seasonal pattern bottom should come in around October 1st. And then we can muddle around a little bit and start trending higher. As we start to see the shape of the midterm elections firming up, whichever way it's going to go, once we start knowing how it's going to go and we can factor it in, then it becomes less of an unknown risk and more of a certainty that people can plan for. Like I said, it doesn't matter how it's going to go as much as knowing how it's going to go.
I would just add to that, looking back since 1950, which as far as I go back on my analysis, the month of October has risen 62% of the years since 1950. There have been 30 months where September's gone higher, and 37 months where it hasn't. And during those 30 months when September has gone higher, October's gone higher 60% of those months following. So in other words, it doesn't seem to have that much of an impact on what we typically see in October based on September being strong. Now, again, there's so many factors that go into this. I don't want to just make a blanket statement and say, well, chances are October goes higher. I'm going to pay attention a lot to the technicals and what all that's telling me. But I didn't see any statistical data that would support the fact that September went up, and so therefore October should go down. I didn't find anything like that. Any other questions, Erin?
Nope, that was pretty much the majority of, when you kind of put them all together. Let's see. Actually, here's one that just came in. looking at the silver chart, could the emerging markets down move, or it says, okay, could the emerging markets down move and potential up move you are showing support the move in silver you are expecting? And I think that kind of is wrapping up what you just said, but.
Yeah, Tom touched on the dependency of October versus September. If September, then October, and it doesn't really work out that way. I don't think that trying to combine if silver breaks this downtrend, then what does emerging markets do? I don't think that there's a dependency there that makes it work in a reliable way. Their correlation is much more random and not tightly correlated. So I don't think you can form an if-then statement from what you're seeing.
All right. That pretty much covers that. Go ahead, Tom.
Yeah, I've got one more question for you, Tom. I was listening to you talking about the presidential cycles, and I know you do a lot of work in that area. And you had mentioned earlier in one of your slides that the first couple years of the presidential cycle are much more calm. And then you get into that third and fourth year, you tend to do much better. And I know so far in this cycle, the first 2 years of Trump's presidential cycle has been very strong for the stock market. Is there any other precedents where we've had a president where we have had an initial boost those first couple years? And do we have any precedents what we could expect maybe in the next 2 years? Is it more to flatline, or is this like you said, a sign of strength and more strength to come? You have any thoughts there?
A lot of thoughts, more thoughts than answers. This is definitely a different style of presidency than we have now than we've used to having before. Typically, the whole reason why the stock market is flat during the first 2 years, and especially so when you have a first-term president, is that when a new guy gets elected, he tries to fix everything that he thinks is broken during the first 2 years. And usually they discover that, oh my gosh, conditions are even worse than I told you about during the campaign. And the only solution is whatever package of tax cuts or spending increases or something they're trying to get through Congress. That's usually how it goes for the first 2 years. And people get bummed out hearing, oh my gosh, things are bad, things are worse. So they tend not to be investing. And then once the midterms go by, the new guy spends the most of the third year and all the fourth year declaring victory, telling you how great he's made things because of all the fixes that he made, and that you should reelect me. Well, that's usually how the script runs. We have a different president right now who is definitely going about fixing things he thinks is broken, but he doesn't mind telling you right now that he's declaring victory and that things are better. So all of that script of the third year, things are better, or you should reelect me, that's getting pulled forward. And that's having a predictable effect on boosting optimism, certainly, and boosting investors' willingness to part company with their cash in exchange for stock. But it's a lot of that also is actual money coming back to the U.S. and having to get put to work. There's really only two fundamentals that matter when it comes to the overall stock market. The first fundamental is how much money is there, and the second fundamental is how much does that money want to be invested. Well, if you put a bolus of additional money into the stock market, you get a big increase in it, like we saw in 2005 when there was a repatriation spike that pushed the stock market up then, and for a couple of years after, we're seeing money coming back and it has to go to work. So some of that may be continued into the third year, where we have the combination of continued optimism and that money coming back. But with all of the problems of liquidity that we're seeing elsewhere, for example, the high yield bonds not participating, the Hindenburg omens, I'm not as confident as I wish I could be right now about getting the bullish third year effect.
Yeah. Well, you mentioned the money coming back in, and of course we talk about that a lot, and we got a big Fed announcement coming up in just a little more than an hour, and that's another possibility where if something that they say triggers more selling in treasuries, you could see that same effect with the 10-year treasury yield breaking out and a lot of money coming out of treasuries. And then you got to say, okay, well, here's the money. Is it going to get put back to work into the stock market, or are those sellers of treasuries comfortable just sitting in cash, or maybe looking for something else? I guess we'll find out answers to all those questions here starting in about an hour.
And as with every other Fed announcement, it's way more important what they say than what they do.
Absolutely. Completely agree with that. And that's why you get so many crazy moves back and forth after an announcement, because you've got so many different interpretations of what the Fed is has said. And then, of course, you're going to get all the Fed presidents coming out and talking about, giving their opinions on things. So I expect some volatility here in the coming days for sure. Well, it was awesome having you on here again. You always share some great charts with us and give us some things to think about that are a little different than what we talk about here on the show. I mean, some of those charts are pretty powerful in terms of how they line up with the stock market. And some of them, when you have to move them a year or a couple years and they continue to kind of line up with the market, it's pretty amazing stuff, actually.
I like getting the answers ahead of time.
It's never a bad thing. I agree with you. Although I can tell you what happened 6 months ago with certainty.
You just don't get to trade that way, though, do you?
No, they won't let me. I tried. Always great having you on here, Tom. Thank you so much for stopping by.
Thank you, guys.
Mm-hmm.
All right, there he goes. Time for the 10 in 10. Erin, what do you got?
Indeed. Let's see. It was interesting. The sector that was leading today is healthcare. And as you can see, we have the new XLC, the communication services sector, now on stock charts, and we did get one request in that area. So thought that was interesting. I always like to see where the emphasis is as far as everybody's requests. This was interesting to see real estate and technology in here as well. So anyway, we'll go ahead and move right on into it. Tom, go ahead and get that screen, and we'll start with Williams-Sonoma.
Yeah, I actually like Williams-Sonoma. I like it so much I bought it 2 days ago. But it went down. You can see here testing a key area of support. These lines that I've drawn in here, when I see gap ups with earnings, there are a couple of things that I tend to gravitate toward. Sometimes when you get a huge move like this and a big gap up, sometimes the top of gap support is all the weakness you see, and then you turn back around. That's what this chart looked like for a while. Looked like we were going to make this push to the upside. But unfortunately, at the time, we never made the breakout in the specialty retailers. And I think Williams-Sonoma just simply went through a period of consolidation. I don't think the huge move up that we saw back from May to June should be lost either. I mean, this was a stock that was trading down around 47 in May. And when we hit our high in August, and we're talking less than 3 months later, we had moved up more than 50%, which is a pretty big move for a stock that had just simply been going sideways for a while. So I think there is a consolidation that's taking place in Williams-Sonoma. I actually had bought it once before, and I think it was right at about this 67.5, 68 area, and I got stopped out when it went below the 20-day moving average and closed there. So I've just kept it on my list, and I've kind of watched these other levels, and I think it's still possible we fill this gap all the way down to 62.5, although as we get closer and closer to that level, I think the reward to risk really starts to turn in your favor on the long side. So I'm a fan of Williams-Sonoma. I'm watching the specialty retailers look like they're trying to break out today. And so we have seen a trend reversal in terms of the relative strength of Williams-Sonoma versus its peers. But again, don't lose sight of the fact that we've had a couple of huge moves up in relative strength when we've had these big advances with earnings. So I think after the consolidation, I'm looking for a move back to the upside. I think it could come sooner rather than later. I would be a buyer of Williams-Sonoma from current price, literally all the way down to about 62.5, 63.
All right. The most popular in the chat room, and good thing it was because we've looked at it within the last week, and that would be Square, SQ.
Yeah, Square made another breakout yesterday. I would just say this. You do have a negative divergence in play, but the breakout was on extremely heavy volume. It's hard for me to argue slowing momentum. Here's that negative divergence. Lower PPO, higher prices. So if you just look at that, you say, wow, momentum is slowing. I've got a negative divergence. But it's hard to argue you got momentum slowing when that new high is accompanied by the heaviest volume you can see on the chart. To me, that reeks of accumulation. So I think that you've got a breakout that I would trust to the upside. However, if you fail to hold the breakout, then I think you risk perhaps a move back down to test the recent low and maybe that rising 50-day moving average to get a center line reset. But to summarize here, I think Square is a great stock. It's been a great outperformer. It's in that financial administration space. It's been very strong. So I'm a fan of Square. I just think if we fail to hold the breakout level, then we might see a little bit more selling and give you an opportunity to get in a little cheaper. But I think 3 months, 6 months from now, the stock's going to be higher, in my opinion.
Okay. Let's see, the next one is an industrial defense, Aerojet Rocketdyne, AJRD.
Yeah, I got this one, and I'm kicking myself right now for not selling when I saw it hit the 20-day yesterday. Let me stretch this out a little bit. First of all, I think defense stocks in general, this is one of the groups that tends to go up almost every month throughout just about every year. I mean, defense stocks tend to do very well. I've been watching kind of the 33, 34 area as support, and I almost sold the stock 2 days ago. I mean, I've had so many emotions on trading the stock the last couple of days, and the only reason I didn't was on the big drop here the last couple of days was the volume. I mean, volume was just kind of average, if anything. And then yesterday we picked up a little bit, got that bullish engulfing. I was looking for a huge hollow candle today, heading back to 37. And of course, my dreams were shattered. The stock is coming back down, but it is off the earlier low. It was down over $1, I think, earlier, close to it. Trying to rebound. What you want to see is a move back up through that 20-day moving average. That's typically the pattern with these stocks. When they go up and they consolidate, they come back down below the 20. I really like to see that push back up through the 20-day moving average. So I'm looking at the 20-day to the upside and this recent support area around 33. It could go below 33 and still be fine, but the next level is going to be down around 31 and a quarter, 31 and a half, and I'm not interested in following it down there. So I'm hoping that the lows that we've seen these past couple of days hold.
All right. Let's see. The next one I have for you is Sunoco Products, SON.
All right. Sunoco, well, I like the candle today. I love this reversal on the 50-day moving average. We did see some selling coming in. Here we had higher prices. We had the lower PPO. Now we're getting the 50-day test, which is almost a reset of the PPO. It's getting down close to the center line. And you can see for the past several months when we did get the one trip down to the center line and near some price support, that was a great time to buy. And I think we're down there again. So I would, again, just annotate and show the recent lows down here, maybe the high. See all this consolidation. If we get back into this zone, which we did earlier today, I think that's an area where I expect to see a reversal. So I would be a buyer between 55 and 56, maybe a tight stop to the downside, and my target initially up closer to probably 58.5, 58.75.
All right. Let's see, from that new communication services sector, how about Charter Communications, CHTR?
Well, it's strengthening, still way off the February high. So on a relative basis, this one hasn't been great. We had the huge volume sell-off. Saw a little bit of volume pick up here recently, although that wasn't even on a very important day. Let's see the numbers. Look at the support area. There was definitely gap support there. There was a reaction high there. See, we've kind of gone through this zone, which is good. I'd like to see more volume. If I was trading this one, you got a PPO that's rising. Volume did recently come in after the breakout, and now I would be looking for any kind of a pullback to hold the rising 20-day moving average. You can see it back here a couple of times. And so that's, if you're in an uptrend, that's what you expect. So I'd keep a tight stop here, close much below that 318 level, 20 days at 318 and a half. That would probably have me out of the stock because it hasn't been a great performer, as you can see on a relative basis. So mixed signals here, but I would say I'm okay on the long side with a tight stop.
All right. From the real estate sector, Hersha Hospitality Trust, and that symbol is HT.
Okay, HT, so far holding support right where it needed to. The breakout, and this is TA 101, broken price resistance becomes price support. There was your prior high. We sideways consolidated for a bit. We made the breakout. Probably would have liked to have seen a little bit more volume on the breakout. Right at the top, shooting star candle, reversal. We come back down, and where do we stop? Right at the prior breakout level. So I think the 50-day moving average and the recent lows around 2250 I'd watch pretty closely. I would be expecting, though, maybe for it to trade in a pretty narrow range between about 2250 and 2375.
All right. The next one, I'm not sure I really want to pronounce this pharmaceutical's name, but Mallinckrodt, MNK.
Yeah, this one's on my strong earnings chart list, and I've been watching this one. I'm watching it for the top of gap support. It's been in a steady decline, but it was outperforming quite a bit. And you can see the volume was really coming in much stronger on this move up than it has been on the way back down. But this is where I was talking earlier, top of gap support. I would even say that tail. And the reason I like these tails on these gaps is that they were selling intraday that took it down to this level, and then the buyers stepped back in. So I think 27 to 28 is key support. You've got resistance all the way back up above 36. So as it gets closer to this zone, I really like the reward to risk on the stock. I'm not ready to pull the trigger here, but it is one that I'm keeping pretty close on my radar.
All right. And this one is an interesting chart, and I know why it's looking like it is. Consumer Staples, New Age Beverages Corp. Talk about a parabolic, and the subsequent decline has put it pretty much down where I would expect to see it at around $4.
Yeah, this is a company I've spoken about recently. They've got a conference coming up in the second week of October, I believe. And I think that it could still have some interest going into that meeting, but the problem is trying to manage your risk on a trade like this. I mean, the stock was at $1.50. 5 days later, it's at 10, and then the very next trading day, it's at 350. I mean, how do you manage risk in this stock? I will say, though, that the top that we saw back in January, we went through with massive volume. So far, that's holding to the downside. We got another key gap support, maybe down around 330, and this 20-day moving average, which hasn't even been tested yet, is at right about $3.30 as well. So if I was going to be looking to get into NBEV, and again, you've got to be willing to take some inordinate risks getting into a stock like this because it's so volatile. Probably isn't for 95% of you, but for the 5% out there that kind of have that more of a gambling mentality when you trade, this is one that down in this range, $3.30 to $4, I could start to make an argument for it technically, and especially knowing that it's got some hype coming up with this conference in about 2 weeks. So it's, I wouldn't be pulling the trigger at the current price. I mean, literally tomorrow is a crapshoot. It could be up 20%, it could be down 20%, but I would start to feel a little bit better about managing my risk if I get it a little bit lower.
All right. Apparel retailer for you, Express, EXPR.
All right, EXPR. Yeah, this is one that came out with great earnings. I remember actually traded this one. I was kicking myself because I got in, played it perfectly, but I got out really quickly, took a quick profit, and then watched after 4 days, watched it go all the way up another 20%. But hey, a profit's a profit. I'm not going to complain. But it did come out with great earnings. It did gap up, went back down intraday, and then rallied again. And you can see it broke out above the prior high back late 2017. I think this stock's going to go higher. I like the volume coming in on most of these moves to the upside. And I think you've got a nice little trend line that you can follow here. So I think connecting the lows probably, I don't know, something like this. And again, you can connect trend lines just about any way you want. But I think the key is you're putting in higher highs and higher lows. So I see a channel or at least a trend line. And as long as we hold the recent lows, maybe around 10.25, I think that this trend line remains in play. I think you're going to break out. I like the stock.
All right. And our last one from the technology space and software, Paylocity Holding Corp, PCTY.
PCTY. Well, you got a reversal with a slight negative divergence. Okay, this one's trying to bounce off the 20-day moving average, which I find short-term bullish. But I would be careful with the negative divergence that's in play here. So anytime I get prices that are going higher and that PPO starts to roll over, it makes me a little nervous that maybe we'll get this 50-day test and the PPO will work its way back down toward the center line. Now, when it did make this breakout, volume was still pretty heavy here. So if this is not a light volume advance, it could simply bounce off this 20-day moving average. I would be watching the recent lows as good, solid support. And that's right at about 79 or so. I think if you close below 79, I would be a little nervous in the near term for a 50-day test. But as long as you hold that, I think you've got a good shot to maybe head back up to 85, maybe even that intraday high around 88. So I like the stock. I think even if it does get the 50-day test eventually, I think that this is one that's been an uptrend, heavy accumulation, and I think any selling would actually become quite an opportunity.
All right. And that concludes the 10 and 10 to 1. And here are the symbols that we just went over and Tom annotated. You'll find these charts in the decision point. No, the Market Watchers Live chart list. Just go to the blogs page, click on the Market Watchers Live chart or blog, and then you will find the link to the Market Watchers Live chart list right there at the top. And of course, they're in every recap that I write in the evenings. All right, time for our final market update. Let's see what the market has been up to while we've been enjoying ourselves with Tom McClellan in the 10 and 10. All right, markets are up right now, as you can see. Dow Jones Industrial's up over 72 points right now. S&P 500 has started to get above yesterday's intraday high and is currently trading near intraday highs. It is up over 8.5 points. We've got the NASDAQ. The NASDAQ is up as well. Does seem to have found some overhead resistance here at that earlier intraday high in the morning. OEX, S&P 100 forming somewhat of a flag right now on that 3-day chart, 10-minute bars. And we can see that S&P 400 and small caps all trading in the negative today. But they are starting to make a comeback. They've really pretty much taken back all those losses from earlier in the day and are trying very hard to get up over yesterday's close. TSX is also on the rise. It started with a nice jump in the morning. It did pull back, but currently trading somewhat near those intraday highs. TSX is up about 54.5 points. TNX is lower right now, reading 3.078%. UUP was up on the morning, but fell back down into negative territory. Made an attempt to get back into the positive, but is now trading below yesterday's close, currently at 24.99. GLD gold is lower on the day, big gap down, but is trying to make a bit of a resurgence here in the last 30 minutes, but is still not near the high, of course, for the day, which is still on the downside. We'll have to see if that gap resistance can be broken before the end of the day. TLT bonds are up slightly, 23 cents, and we see that USO is down on the day, formed sort of an interesting little diamond pattern here, and you don't see those too often, but they're usually not on a short-term chart, but those are usually bullish, so I would expect to see oil make a comeback here, and I don't know if we'll see positive territory today, but I'm expecting oil to continue its rise. USO is currently reading at 15.20. And that completes the final market update. Tom, did you have a chart that you wanted to show us?
Yeah, I'm going to take a look at Facebook because Facebook, of course, I've been trashing the stock for a while. I'm not ready to stop trashing it just yet, but technically it is starting to show some strength. I actually changed my chart around a little bit to show both the PPO and the PMO, and you can see both have turned higher and made that crossover. I know, Erin, that's one of the things you like to look at, and we are getting that cross on both of those to the upside, and we're trying to get a breakout above the 20-day moving average, and since that earnings debacle back in July, we have not had a close above the 20, even though we have tested it and we've gone above it intraday. So for those who are interested in Facebook and are looking for a possible bottom, I don't know that we've bottomed. We have gone down and filled this gap at 160. I think that's a really big, important level. We're bouncing off of it so far. I think the next level that we're going to need to watch, though, is this 170. That's where the initial selling stopped after earnings, and we got a couple of bounces, and then we broke that level. So I would just say that right now, I think Facebook, from a price perspective, is between 160 and 170. So if we go up, we hit that 170 level and fail and start to turn back down, I'd be careful. But again, for those who are looking maybe for a bottom and starting to turn back up, we are starting to see at least some initial positive developments on Facebook stock, and we'll continue to follow it, see whether or not it does get that confirmed close. But for now, intraday is all we got, so we'll go with that. All right, well, I know we're going to go into the What Would You Do segment. And so what we're going to do today, Erin, is talk about Nike. They reported last night, and this was our poll today, but they reported last night their quarterly earnings, and they were good. I mean, they beat top line. They beat bottom line. Their top line came in at $9.95 billion. Market was only expecting $9.92 billion. And then bottom line, they came in at 67 cents versus 63 cents. So I guess the question here in the poll is, what do you do with Nike? I mean, what would you do? What would all of our viewers do? And we gave them some different options. And right now they're choosing the do nothing option. Kind of watch it, 35% of you. 22% saying buy it if it hits that 50-day moving average. 19% are saying buy it later, waiting for that PMO to turn back up because it does look a little skeptical, and I'm sure you'll get into that in just a minute, Erin. 11% say buy it at price support near 79, which is where we have recently gone down to. I think there's a double bottom around that level. 7% are saying it's been a great stock. It's in footwear, which has been strong. I'm just buying it today on the weakness. And then 6% are saying short it. There is a negative divergence in play. But what do you think? I mean, why don't you pull the chart up and take a look at it, your style, and let everybody know what you would do.
Absolutely. I'll talk about it, and then I'll give you what my answer is. All right, here. All right, so this is the daily chart of Nike. And, you know, obviously, you'd have to be living under a rock to not know the news that's been going on about Nike outside of the chart. I kind of think that might be part of the reason we're seeing that downtick, maybe an anticipation that next quarter is not going to be quite so good, you know, based on, you know, all of the news going around with their new campaign. So, you know, obviously it doesn't look like it really has hurt them so far. They are starting to turn down here, of course, like you were saying, and earnings having that beat and then still falling, and it is down almost 1% today. All right, so what I did mark were, I marked this rising trend channel, and then I opted to mark where we've had sell signals previously on the PMO, because I wanted to see how late they were coming in. Because a lot of times, you know, based on what I use as my parameters for the PMO, sometimes, you know, it comes in a little bit late. That's why I know some people increase their parameters a little bit, but this is how we made the PMO. This is how I visualize it, and I know what it tells me based on these parameters. So that's why I always keep the same ones. I think they work best, at least for my mind. So I looked, and they have come in late a few times. You can see right here when we started to get, you know, a little bit more compacted, a little bit flatter on that PMO. They came in a little bit late. We don't actually have that sell signal yet. So that could be coming in, you know, it looks like it'll be coming in, and it could come in late. Now, if we do get, what I'm thinking is a possibility here is a bounce off the bottom of this rising trend channel. I mean, it has stayed mostly intact, minus that pop back in June. It stayed within this rising trend channel since, you know, it was developed really back in April. So I think there's a high likelihood that this rising trend will continue. And, you know, I would prefer to wait for the PMO to turn up, but just given the way we've seen some of these sell signals come in, they do seem to come in just a bit late. So I would expect a little bit more downside. I might even consider this off that 50-day EMA. So I'm a little bit different than what my normal, you know, trading pattern would be, just because I'm looking at this particular chart with this particular news. And I have to put some serious weight into this rising trend channel. It's, you know, it's really held up nicely. So I would be looking for a bounce likely off of that 50-day EMA. I think we're going to get an opportunity here to get in with a bounce off that 50-day EMA. But my trading style, as everybody knows here, is I don't get into stocks where the PMO is falling. I just don't do it. It's not part of my methodology. So for me, I wouldn't even consider it as a trading candidate until I saw the PMO turning up, because that's my trading style. I stay true to my process. So even though this looks pretty good for a bounce off the 50-day EMA, which also seems to match, look at this, since May, the 50-day EMA has pretty much ridden that rising bottoms trend line. I mean, that's pretty strong support. So I would expect to see it go back up once it hits that 50-day EMA. So I don't know if that's going to be your answer, Tom, but I have to say, looking at it, that's more than likely going to be my answer. Would be my answer is still that the PMO has to turn up. But I'm curious what yours is going to be. I just wanted to show really quickly the weekly and the monthly charts. Here's a problem that I think you should be aware of is that we are looking at a very overbought PMO on the weekly chart. But you can see, remember we looked at that one rising trend channel on the daily chart. Look at, we have another one, longer term, that goes back into 2017. Of course, to test the bottom of this particular rising trend channel, we would have to make a move, could make a move all the way down to $80 on it. But, you know, that's held up as pretty strong support, that trend channel. But I would be a little concerned about that PMO. And then finally, just quickly looking at that monthly chart. Longer term, I think it looks better. And that's because we do have that PMO buy signal. And the one thing you may not notice here is that the monthly PMO has been in the positive territory for the last, is this a 20-year chart? It's been in above zero by a lot. So it's a pretty strong stock when you consider it in the longer term, you know, if you don't mind taking a little bumps and bruises along the way. But it's looking pretty good as a longer term buy and hold as well right now.
All right. Let me pull
So
up.
as far as the poll goes, my answer would be buy it later when the PMO turns up. But I have to say, I would want to see how far below that rising trend channel things went if we didn't get that bounce off of that 50-day EMA.
Okay, cool. I'm going to take a look at it a little bit different. First, let's just talk about footwear stocks in general. And here is a relative chart of the Dow Jones U.S. Footwear Index relative to its consumer discretionary peers. And you can see that after a lengthy downtrend, in October we reversed and we've been in a nice uptrend, meaning that of the money that's going into consumer discretionary, footwear is getting more than its fair share. It's been doing that now for almost a year. And so I like to try to find areas of the market that are outperforming. So I think you have one here with the footwear stocks. Now let's take a look at the XLY versus the S&P 500, and you'll see also that money is rotating clearly towards consumer discretionary. When we take a look at what's going on with the S&P 500, consumer discretionary is a big reason why we've been seeing such outperformance here in the U.S. Many of these stocks have been performing extremely well. So you've got a great sector. You've got a very, very strong industry group for now. And so then it just becomes a question of which stocks within the group would you be interested in. Now, Nike just reported great results. And so I'm definitely going to be interested in Nike. But the question is Nike the best alternative in the footwear space? And I'm just going to talk about a couple of stocks. First, Nike. I want you to know that when we look at the seasonality chart of Nike, that September is its best month. And I talked about that before September ever began. And so I'm not shocked that the stock has had a good September. It usually does. It goes up 75% of the time, even though historically September is the worst month of the year for the U.S. stock market. But if you look ahead, October, November, and December continue to be very strong months for Nike. So looking seasonally, looking fundamentally, and then also looking technically, I don't think that the train is stopping here on Nike. I think Nike goes higher. So now it's just a question of whether or not I like anything better. As you look at the footwear stocks in general, in terms of their seasonality, you will see that September, October, November, and December are very strong months. This is a good group during the fourth quarter. So we've got, again, great seasonal period, a great stock within the group, a great group within consumer discretionary, and of course, consumer discretionary being strong relative to the S&P 500. So I don't see any end to the party at this point in time. So I'm going to be a fan of Nike. So let's take a look at a couple of other stocks, though, that we might want to consider as an alternative to Nike. Crocs even though it has a nice scooter here, and I think looks pretty strong technically, been trending higher, does have a negative divergence. And when I go back here and I pull up the seasonal information on Crocs, I'm going to find October and November are not good months. Over the last 13 years, this stock has averaged going down 12.4%. That's enough right there to tell me that I prefer Nike during this period of the year. I'm going to feel much better and safer having Nike in my portfolio. But a couple others that I will talk about that I think are maybe noteworthy and could be considered. Deckers, DECK. November and December, look at these 2 months. Averages going up 12% during these 2 months. October, not so great. And when I look at the chart on Deckers, you can see that it's bouncing off support. It's starting to strengthen again, and it's been sideways consolidating off of an uptrend. So this support level was very, very important. It held around 110, starting to make a move. I could see this stock, if it continues to consolidate in October, making a big run come November, December. So this is one I'd keep on my radar. And then the last one I wanted to mention was a stock that is being shown no love, Skechers. And I'll explain why in just a second. You look at this chart and you say, what in the heck? Why would you even be thinking about this one? Well, not really thinking about it yet. But if we stretch it out and go back the last couple of years, you can see that it does have periods where it does very well. Obviously, that is not one of these periods, but it does have support down around 24, maybe 23. We've had many lows over the last couple of years down in that range. And this is one that I want to mention also from a seasonal perspective. This is crazy how Skechers and Nike kind of flip. You can see September minus 8.6%, October minus 3.9%. This is not the time you want to be in Skechers, and I think that chart shows you really over the summer, all the way back since April. This is the time when Skechers struggles, and that's exactly what we've seen. November, December, January, February, March, and then April start a very bullish 6 months historically for Skechers. So the only thing I would say is as we get further into the fourth quarter, look for some good news on Skechers. If it starts to look better technically, don't forget the seasonal pattern here. So getting back to the poll, I would say that looking at Nike, and I'll bring up this final chart here, I would be a buyer. I think I'd be a buyer on weakness. I think it's going to hold. Probably today's low is going to hold. There is a slight negative divergence, but this is very heavy volume, and we're rebounding off the earlier lows. So I think the stock goes higher. To the downside, I think you do have great support at 79. I'm just not so sure you're going to get there. So I would go with a buy on the current weakness.
Okay. So I guessed I didn't guess properly or correctly as far as what you were going to answer. I think you knew already as soon as you put the PMO into the poll that would probably be my answer.
Well, I was looking at it from a PMO perspective because we talk about the PMO a lot here on the show. So I wanted to make sure that everyone's looking. I mean, I guess it could have said short it because the PMO looks like it's starting to roll over. Mm-hmm. But yeah, I thought that might be a popular answer waiting for that PMO to turn back up.
And it turns out to be a pretty good one.
Yeah. So it's another solid day. Great information from Tom McClellan once again. So happy that he was able to join us today.
Yes. And tomorrow Dan Russo is going to be here. So that'll be a great show as well.
Yep. Chaikin Analytics. So you'll be able to get his latest thoughts on what he thinks on the market. So got a lot coming up. You can check your screen for everything we've got going. And we got a bunch on there. So going to be an interesting next week or so. Thanks to everybody for stopping by and being with us today. Please remember to complete the survey as you exit. I'd love to hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.